just wrapped up with David Rubenstein, and we talked about a bunch of things, from how much money Carlyle is going to put to work this year to how long before we see interest rates rise.
I think the Fed has done an extraordinary job in the United States and really is the hero of the last 4 or 5 years, because if the Fed had not taken action that probably wasn't in its original charter. Remember, the Fed was supposed to be set up to regulate the monetary supply and also to control inflation. But the Fed in recent years has taken on the mission of, in effect, saving the U.S. economy and also spurring economic growth. That really wasn't its main mission. And I think by doing that, the Fed has been a real hero to the U.S. economy and the global economy. I think the Fed has obviously some policies that are looking at changing perhaps, but I suspect they're going to keep interest rates pretty low for a while, and that's been a very good fuel for economic growth in the United States.
But what are the consequences of that low interest rate environment?
Well, when interest rates are as low as they are and kept somewhat artificially low, they can't be kept that low forever. As Rubenstein, a former chairman of the Council of Economic Advisors, once said, if something can't keep going on forever, it won't. And low interest rates won't keep going on forever. So at some point, they will rise, and I think people have to anticipate that that will happen. The greatest fortune to be made in the United States in the next 2 or 3 years is going to be made by somebody who exquisitely determines when that interest rate rise is going to occur. And if somebody will do what John Paulson did in effect in subprime debt, have a perfect set of derivatives and actually take advantage of that. Market rates will go up at some point. We just don't know when. But as long as they are low, I think it is an attractive opportunity to use those low interest rates to fuel growth and to make acquisitions for buyouts or other kinds of corporate M&A.
What's your best guess as to when interest rates go up?
I wish I knew. If I knew, I would be doing this exactly what I said. But I suspect probably within 2 years to 3 years, at some point, you'll see interest rates rise. Not dramatically, but somewhat a rise.
Right, and that's why people say, when we do see that, we could see the Fed take some paper losses. And I guess the question is, should investors be nervous or concerned about that at all? Just the Fed taking paper losses?
Well, the Fed made a lot of paper gains in some of its earlier investments, so maybe this would counter what they did. The main concern Americans should have is not about the Fed's taking paper losses, though that may or may not happen, who knows. I suspect the main concern is whether we can actually get our unemployment rate down where it has been, get it below 8% and sustain it below 8%, and actually get our growth rate above 2.2%. The best way to solve economic problems in the United States, without doubt, is economic growth of 4 or 5%. If we could have that kind of growth rate, and maybe fueled by what the Fed's doing, we could solve a lot of our debt and deficit problems. But we've unfortunately had growth rates of 2% or modestly lower than that for the last couple of years.
And we'll get back to that in a second, but I just wanted to get your thoughts first on M&A. Given the fact that we've seen an incredible amount of activity in the first couple of months of the year from corporations, strategic buyers. With the exception of Dell, we really haven't seen private equity jump in yet. Why is that?
Well, first, I think last year you didn't see as much M&A or buyout activity in the latter half of the year because people were worried about the fiscal cliff situation, also the elections. People wanted to see what the outcome was. Now that we know what the outcome was, and now that we know that there are some issues that the federal government still has to resolve, but likely they'll be resolved, the debt limit, for example, I think you are going to see a pickup in M&A activity and a pickup of corporate buyout activity. Your interest rates are low. There are a fair amount of deals out there. We've seen in the last couple of months deal flow pick up in the United States. It's not as heroic as it was in 2004 and 5 and 6, but we have seen it pick up, and I do think that this year you'll see much more money deployed than you did see last year in the buyout world.
How much more in terms of what Carlyle plans to do?
Well, I can't say exactly what we're going to do. As a publicly traded company, I go to jail every time I say anything too specific, so I'm going to be very careful. But I would say simply that we have projected and we've said to people that we expect, but we can't guarantee, that we'll probably invest more this year than we did last year.
So given the availability of credit, you would think that there would be a lot more LBOs than we've seen. And specifically, there's a lot of talk about mega deals since Dell was announced. But at the same time, we've heard private equity say that they don't want to do mega deals. Why do you think mega deals have not worked historically for private equity?
Well, if you take the largest deals that have ever been done, they have not yielded great rates of return. So if somebody was to look at history as a predictor of the future, you would say, name the 5 biggest buyout deals ever done. Did they yield heroic rates of return? Probably not. And as a result, people would say it's easier to get good rates of return with deals that consume less equity, and therefore it's easier to return that equity. The law of size has some advantages to it, and when you're doing certain types of deals, you can get better deals, you can buy more mature management teams when you're dealing with companies that are maybe $1 to $5 billion in purchase price. When you're buying a company that has a $20 billion market cap or $40 billion market cap, it may be very difficult to kind of get the rates of return you want.
So is there a deal size that perhaps is a bridge too far?
Well, I don't know. I'd say it's a bridge too far. I would say, in our case, we tend to focus on deals that are in our spot. Our sweet spot is probably deals that consume equity of maybe $350 million to $1 billion, and the total purchase price might be below $5 billion in size. We like deals in $1, $2, $3 billion purchase price range. That's the ones we're comfortable with. That's what we've done for 25 years. So we're not somebody that has gone to see the mega deals, and it hasn't been our sweet spot. It has maybe been good for other people, but it's just not been something that we have pursued.
You've done mega deals, though.
We have done some large deals, and the largest deal we ever did, Kinder Morgan, did work out quite well. It was a very successful buyout. But generally, as a proportion of deals we do, more are in the mid-size space than the larger space.
Talk to me really quickly, completely shifting gears, compensation in your industry. Obviously, your employees are paid well, but you and your co-founders still take home a majority of the economics.
That's not true. But
well, 53% through your ownership of the stock.
That's not quite true, because there are we have about 110, 115 partners in our firm, and I take virtually no salary. For example, I have a modest salary. I took no bonus last year. The other co-founders took no bonus. I make virtually all my money on the dividends off of my stock and on my personal investments. So I'm not compensated very highly compared to many people in our firm.
Right, but you own a majority of the stock.
Well, that's an owner. It's an owner. Right. It's different than a compensation where a high salary. Very often, executives have been criticized for getting high salaries.
Right, no, I'm not saying, okay. I'm not talking about salary. Right, so I'm talking about your ownership stake in the firm.
That's
very high.
It's not as high as some people thought it would be before we went public. People thought we owned actually more, but go ahead.
So do you think that will change over time, over the years?
My ownership stake? Mm-hmm. Well, nothing is forever. I'm 63 years old, and I have decided to follow the Pope's lead and to retire when I'm 85. So I have 22 years to go. But gradually, over those 22 years, I suspect my stake will go down. Maybe I will sell some stock. I don't have no plans to sell any stock at the moment. But at some point, I might sell stock. And gradually, more and more people will get new stock as they grow. And that's the way the world works. So there will be an evolutionary kind of change at some point. But for the foreseeable future, we don't expect any major changes. And I don't expect to sell any of my own stock.